Your briefing from John Thomas, the founding father of the international hedge fund industry, will begin momentarily.
Hello, this is John Thomas, the mad hedge fund trader. Did you know the top 3 global stock markets in the first 6 months of 2010 were Bangladesh, Sri Lanka, and Venezuela? Or that Mongolia's stock market is up 100% in the last year? What's going on? It's simple. Jim O'Neill, Goldman Sachs analyst who came up with the BRIC concept a decade ago, is shifting Goldman's focus onto 11 frontier or pre-emerging markets, and oceans of hedge funds and other money are flooding into them. These countries are completely off the radar of regular investors, but in the next few years you won't be able to shake a stick without hearing about them. It's no wonder either. If you'd acted when Goldman Sachs announced the BRICS, Brazil, Russia, India, and China, then you got in on the ground floor of some of the best trades in the last decade. China exploded 192%. Brazil shot up 376%. India handed investors up to 407% gains, and Russia handed in a gobsmacking 1,107% gain. If you ignored this macro move, then you were likely stuck in the lost decade of the U.S., and you were losing money. First off, let me list these frontier markets for you, starting with the ones Goldman Sachs called the N11. They are Bangladesh, Egypt, Indonesia, Iran, South Korea, Mexico, Nigeria, Pakistan, the Philippines, Turkey, and Vietnam. Others include Mongolia, Sri Lanka, Tanzania, the Ivory Coast, and Kuwait. So far this year, frontier funds have taken in $1.1 billion in new investment compared to the previous record of $443 million. The reason early-stage investors are so excited about these countries are, 1, they have emerging middle classes bursting onto the world economy, and I'll go into more about this in a moment. Second, they're generating white-hot growth rates like Japan saw in the 1950s, Singapore saw in the 70s, and China is seeing today. But the most critical aspect of this for you as a trader or investor is to understand the forces driving these pre-emerging markets up, because once you do, then it becomes easier to play them for profit. As the guy who founded Wall Street's original international hedge fund and worked directly with Wall Street titans like Paul Tudor Jones, George Soros, and others, I can confidently tell you these macro trends are where to make the big money. So I want to break down the big macro trends every investor and trader needs to know about. I'm willing to wager that 99% of Main Street investors will continue missing out on these opportunities. And in case you're wondering how well this information translates to actually making money in the market, you should know that in 2010 alone, I've used these trends to lock in 48 winners and only 1 loser. And I'm not giving up on that one yet. I'll put these numbers up on the screen so you can see the global macro trading I do in my hedge fund is the smartest way for do-it-yourself investors or traders to make money in capital markets. You can see we have 12 winners in emerging markets with plenty of 30% and 50% gains in 5 months. There are 10 individual stocks, the big winner handing us 80% in the last 5 months, a 102% gain in commodities, some plump 14% gains in fixed income plays, and another 100% in precious metals. And thanks to nice little gains in currencies and food plays, we locked in 40%, 48%, 55%, 63%, and 87% among others in the past 5 months. Even better, we locked in 102% gains, 113%, and a mouth-watering 337% gain in metals. Again, this is all just in the last 5 months. My point is, if you know what to play and why, you can make serious money fast. Let me talk now for a while on the major long-term trends that I see affecting the financial markets for the next decade. For a start, there's the growth of the global population, the rise of the emerging market middle class, the scarcity of essential natural resources, the shift from paper assets to hard assets, demographic investing and what is the implications of the silver tsunami, and the rise of technology. And of course, a lot of these trends overlap each other, cross each other, with different implications. I'll start with global population growth because that's the easiest one to get a handle on. It's also the most important trend. I call this the procreation trade. The willingness of people to procreate is something you can absolutely rely on. It's been going on for millions of years. It has entered its exponential growth phase, and there's really not much you can do to stop it. It's one of the reasons why we are still around as humans. To understand why this is an important trend, you need to know who this guy is, the Reverend Thomas Malthus, who lived from 1766 to 1834. He is the father of modern demography. In a series of church sermons in the 18th century, he delivered the theory that the growth of food supplies over time is linear, but the growth of human populations is exponential, and that it is only a matter of time before the human population outstrips the food supply. Because of this, he believed that utopia is unattainable because of resource shortages that will bring famines, disease, and war. The Reverend Malthus's solution was virtuous behavior. I have a slightly different solution to this, and that is buy food supplies before they run up in price. History of the world in one page. During the time of the ancient Egyptians, there were only 10 million people in the world. That wouldn't even make a suburb in Shanghai today. By 1825, the population had grown to 1 billion, and then it really took off thanks to the Industrial Revolution. Today it's at 7 billion, and by 2050, or in 40 years, the world population is expected to level out at about 9 billion people. Now, there are going to be some important changes in the makeup of the world population over the next 40 years, which will have a big impact on financial markets. We're going to be adding 2 billion new people. More than half of the increase will be in Islamic countries. The Islamic population will grow from 1 to 2 billion. This suggests to me, given that the largest increase will be in the most impoverished Islamic countries, that the war on terrorism isn't going to end in 4 years, and that you should add that into your calculations. The current Pentagon budget is only expecting the war on terrorism to last 4 more years. Population levels will level off in Latin America, Africa, and China. In Latin America, families are going from 7 children to 2 children in 1 generation. It took 3 generations for that to happen in the U.S. And 30 years ago, China adopted a one-child policy, which has cut the growth of its population by 400 million. Population is shrinking in Japan, and it is level off to slightly shrinking in Europe. The U.S. is in a slightly different situation. Its population will level off at 400 million by 2050 from the current 300 million. But the U.S. has very active immigration, unlike Japan and unlike Europe, and that immigration adds 1% a year of GDP growth. So scaring off immigrants isn't necessarily a good thing for our economic growth. If you add up total growth projections for the world for the next 40 years, the world is adding 175,000 new customers every day. And the game is to find what those customers want to buy. If you take the Malthusian theory of economics and apply it to commodities, this is roughly what you look like. You see the thin blue line is the world population growth, which suddenly took off in 1825 and has been heading straight up ever since. But the growth of commodity supplies is a linear growth, much like we saw with food growth earlier. And what that means is eventually we run out of commodities and enter a period of chronic hard asset or chronic resource and food shortages. We have had shortages in recent history. We saw them during World War II from 1939 to 45. We saw them during the first oil shock from 1973 to 82. And again, it has started again in 2002. And in all of those instances, you saw huge increases in the prices of all commodities and foods. We're 8 years into this, and I think this is a trend which will go on for decades to come. Trading demographics is another way to play the global markets. This is the population pyramid, a very useful tool that many international investors use for Vietnam for this year. And what this shows is the percentage of the population according to each age group split up in 5-year increments. So if you look at the bottom here, you see there are large numbers of young people and small numbers of old people. This is an ideal country in which to invest. For that simple reason that rising populations create more consumers, and the little need for social services means strong GDP growth, small budget deficits, and a strong currency. When you have a large number